Hello students, let's see an introduction to financial accounting. Remember, usually we used to simply say accounting, but to be more specific, we should say it is financial accounting. I will tell you why, because accounting is there of three types. Okay, there are three types of accounting: financial accounting, management accounting, and cost accounting. Okay, leave that. I just mentioned why I have written it is financial accounting. Up to you, just understand. We are going to see an introduction to financial accounting. First of all, let's see why do we need financial accounting. Here, you can see a shop and a businessman standing near it. From a common man's view, he just wrote this in his book. But after appointing an accountant, he wrote this in his book. Let's see what's that written. We don't know what they have written. We just have numbers. In the business that you can see here, the businessman bought some goods for 10,000 rupees. Okay, and he sold it for 50,000 rupees. He bought something for 10,000 rupees and sold it for 50,000 rupees. Now the businessman is happy. Why? When he subtracted the selling price from the amount he spent to buy those goods, he believed that he got an answer, he got a calculation that he made a profit of 5,000 rupees. I think the concept is clear for you. A businessman, he bought something for rupees 10,000 and sold it for 50,000. When he took the difference, when he see what profit he has made, he found that he had made a profit of 5,000 rupees. Then the businessman was happy. But his accountant had a different answer for him. His accountant took out his book and showed, okay, you have made a sale for rupees 50,000, that is correct. And also it is correct that you have bought something for 10,000 rupees, isn't it? He don't have objection on that, but the common businessman who don't know accountancy have skipped some relevant expenses. Let's take it is for electricity charges, and let this 4,000 be for the salary paid to the accountant. Okay, now he have calculated his profit here. The common businessman have calculated his profit here, skipping these two major expenses. Okay, the accountant who know the accounting principle, who know why we need accounting, he just made sure that every important expenses, every important income is considered before calculating the final profit. So what he got, he didn't got even a profit. What he got instead, he got a loss of 7,000 rupees. You can just calculate here. Just see the difference. When a common man, now from the story let's come to the point. When a common man who has no knowledge of accounting, when he tried to calculate the profit, please understand, not when making the profit, when he tried to calculate the profit, he made such a wrong assumption, isn't it? Because when all the possible income and losses and all the possible expense were considered, the business would have a loss of 7,000 only. On the other way, the common man found he will get a profit of 5,000 rupees. To be frank, to be real, okay, to have a look at the real profit, we can absolutely say that this is the correct one. Why? Even though he is not considering this two amounts for calculating the profit, this exists in the business, he has to pay it, isn't it? So we needn't doubt that this is the right profit or this is the right amount he will get as the result of the business. Because of the lack of knowledge, because of lack of properly recording all his expenses, he misunderstood it to be 5,000 profit. Now I think you have got a small idea why we need accounting, but we need to know something in deeper. Now let's see, from this point, let's see what is accounting. This is the most widely discussed meaning of accounting. Accounting is the art of recording, classifying, and summarizing financial transactions, analyzing and interpreting them to communicate thereof to interested parties. Let's see what all things are mentioned here. Everything mentioned in this meaning is the steps involved in accounting. See, accounting is the art of recording. The very first thing we do in accounting is recording of transaction. Recording simply means writing down of transaction in a proper way. Just think about this example we told just before. The businessman forgot to properly note what the expenses he made within his business. So when he was there to find the final profit of the business, he forgot to take two major expenses and got an ambiguous profit, isn't it? Similarly, to avoid such situations, accounting ensures what? Accounting ensures every financial transaction, every material financial transactions are recorded in a proper way. Okay, that is the very first step of accounting. From there, what we do, we classify it to make it more easy for our calculation. And finally, when it comes to an year end, we summarize it. For what? We need to find out the position of the business, and we need to know whether the business had made profit or loss, like what we did in the last example. At the end of a business, let it be at the end of an year, end of a quarter or something. Okay, according to the size of the business, it may vary. Most probably we will try to find whether the business had profit or loss only at the end of a financial year. Okay, at the end of a year we will summarize every financial transaction. We will try to find whether the business had made profit or loss. From there we have the analysis and interpretation part. That is something higher end part. We need anything just you can just skip that. Okay, now after analyzing and interpreting, what we do, we communicate this information. We communicate what? We will get two information from accounting, whether the business had profit or loss. Also, whether the business has assets or liabilities. We will discuss all these terms in the coming part. Just don't worry. We just need to know whether the business had profit or loss, whether the business have some asset with them, whether they have some liability with them. All these informations are communicated, transferred to people who are interested. No, just think of government. Government want to collect tax from us. No, for that they should know whether how much profit we have made. If we have not made profit, we needn't pay any tax. But if we have made profit, according to the profit going upward, the taxation will also go upward. So the government should know how many profit every business is making. Similarly, there are many people who would like to know how our business perform. So accounting, so what is the purpose of accounting? Accounting will record every financial transactions in the business, will classify them periodically, will summarize them at the end of a period to show the result of the business, and analyze and interpret them to communicate them to the people who are interested to know, someone like the government. Okay, we can look what definition we should give for accounting. Here is a definition by the American Institute of Certified Public Accountants. They say that the accounting is the same thing we have seen in the meaning itself, but remember, being a legal entity, they give a proper definition here. Accounting is the art of recording, classifying and summarizing in a significant manner, and in terms of money. Remember, very very important point, and in terms of money, transaction and events which are at least of financial character, and interpreting the results thereof. Somewhat similar to what we have told before. We just need to have a read on it. Now let's see what are the needs or the objectives of financial accounting. The very first thing is recording of transaction. Financial accounting makes sure that every important financial transactions are recorded. Okay, what help this do? It will avoid all kind of confusion at the end. Just remember what happened to the example we told in the before. The businessman had calculated a huge profit for his business, but what happened? Actually, he was incurring a loss when he considered all transaction which was recorded by an accountant. But the businessman who didn't follow a proper accounting forgot to record. Hope the concept is clear. Just think you are studying in a class, you're just sitting in a class and you are not taking any lecture notes. When you go to home, will you remember everything? No, at least 1 or 2 points you will forget. Similarly, business will have chance to skip important financial payments or receipts, simply called transactions, if they are not properly recorded. So that is a very first and one of the most important objective of financial accounting. So what is the second thing? By recording the transaction in a proper way at the end of a period, at the end of a financial year or at the end of a period we want to know, we can find whether the business have made profit or loss. To be more specific, we can find the actual profit or loss, the actual result of the business. Okay, why we say it is actual result of the business? We emphasize on the word actual because When we did the first option also, when the common man without a proper knowledge in accounting tried to find a profit, he also got an answer. It is sure that they will get a result. Okay, if the result have to be proper, if the result have to be the final one, it has to be the ultimate profit. We should we should follow what the proper accounting procedures. Hope that is clear for you. That is the second objective, the second major objective of financial accounting. Now, what is the third one? We have to find the financial position. Remember, financial position simply means how much asset do a business have, how much liability do a business have. Now, what is asset, what is liability? Asset simply means anything that have value, which can be converted into money, which include money also. Okay, let it be a building of the business. See, if the business owns a building, the building is asset of the business. If the business owns a huge machinery, that machine is also asset of the business. If the business have some money left in the bank, that is also asset of the business, because when we need money, we can make use of it. That's the concept behind that. Now, what is liability? Liability means liability is the totality of money or money's worth that the business owe to others. Owe to others means the business have to pay them. Think the business have taken a bank loan. So this bank loan, the business have to repay. No, one day the business have to repay this bank loan. So it is a liability of the business. Think the business have borrowed some goods from someone. So he is a creditor. He has given something for credit to the business. The business have to repay it one day. So that creditor is also a liability for the business. So financial position means what all assets and what all liabilities does a business has. Finally, to avoid fraudulent or avoid error. Why we say we have to avoid fraud? Fraud means activities, illegal activities that are done knowingly, not unknowingly. Knowingly, if we have done something wrong, that is called fraud. Just think the accountant. When we started with an example. Just think that accountant wrote some more expenses in his own and mentioned that there is a loss of another 2,000 rupees in the business. Okay, think the businessman know nothing about financial accounting. He don't know how to properly check everything. Then what will happen? The accountant can easily steal that money from the business. So to avoid these things, accounting gives a proper way to ensure all the transactions recorded are proper and they have verifiability. They are rectified. They don't have any loophole to make such fraudulent activity. If the proper accounting procedures are followed, there are very little way to make fraudulent activities like this. We can't say we can avoid it completely, but still the accounting principles and procedures try to prevent many loopholes that may arise in its absence. Hope that is clear for you. So these four things are some of the major objectives of financial accounting. When we try to practice this in real life, we can easily understand that. So don't worry if you find it difficult right now. Okay, now we can move to the steps in accounting. I have told before you what the meaning of the accounting itself, say what are the steps involved in accounting. The very first step is recording of transaction. Okay, after recording in a week or in a month, once in a week or once in a month, we will classify it into some accounts. Okay, it is classified into some accounts to make it easy for further analysis, further processing. We will classify it. We will take something in similar nature and put it under a common account. We can know it more deeply when we study forward. Don't worry. So the very first step is to record financial transactions. Now after recording once in a month or once in a week, we will classify them. Then the classified transactions are summarized to find whether the business have profit or loss. After that, this statement is analyzed by experts. Remember, a common accountant can do nothing here. Either he should be an expert accountant or he should have enough knowledge in financial analysis. If he has, he will analyze and give more information, like what the business had performed more better than what they did in last year, or the business is going in this kind of trend, like that. Analyze can give more detailed information, a comparative information. Remember, you can study it in the further classes, but a common accounting will end by summarizing. Okay, it is called a person who do till the summarizing process is often called as a bookkeeper. Okay, now think after analyzing we will communicate what the information, the final information, the compressed form of all information to the people who are interested to know them. So these are the steps involved in accounting. What are they? Recording, classifying, summarizing, analyzing and reporting, and communicating. Now we should move to another place, another important part. It is called gap. What is gap? Gap are the rules which regulate accounting all over the world, making it common and unique for the global accounting community. GAAP or generally accepted accounting principles are a set of rules and guidelines for performing accounting functions which bring unity in the process and making the report easy to compare. So in simple words, GAAP are rules that guide how the accounting procedure have to be followed so that the reports made by every accountant in the world, the reports made by every accountant in the world follow a common format, making it easy to compare. And also we can, if we have a common law, what are the benefits? Anybody can compare their business with anybody in this world. Also, anyone in the world can have a look at how the business in another country, in another state is performing. This brings the global business together. It is one of the major reasons why we have a common link between international businesses. So, what is gap? When we have to study the gap, we have to see how it is breakdown. Gap is mainly breakdown into 4 parts. The very first part is accounting assumptions, then accounting principles, modifying principles, and accounting standards. Here we are going to just discuss what are the accounting assumptions, what are the basic assumptions on which the accounting laws are built, and also what are the accounting principles, what are the principles that guide accounting procedure. Accounting assumptions include 4 basic concepts, 4 basic concepts that are thought, that I believe that every business will accept it or every business will find it acceptable. So these are 4 basic beliefs, 4 basic assumptions which are assumed to be acceptable for every business all around the world. Just we can see what are those assumptions. The very first assumption say that the accounting entity concept. According to this concept, every business is treated as a separate entity from its owner. Please remember, according to accounting entity concept, every business is treated as a separate entity. To be more specific, a separate legal entity from its owner. Why this is said? According to this concept, the assets, liabilities, income and expense. Please note these words. These are very important for you to learn forward. So the assets of a individual and assets of the owner, assets of the liabilities of the owner, income of the owner, expense of the owner are not same as the assets, liabilities, income and expense of a business. Think the owner has a asset worth 100 crore rupees. This doesn't mean that the business will also own this. Please understand. The same time, think a business have a liability of 100 crores. This doesn't mean that the owner alone has this 100 crore rupees liability. He doesn't have to meet it as is it his own liability. He is liable. It is show that he is liable, but according to the accounting principles, when we treat the accounts, it doesn't come that this 100 crores is liable for this person. What will we write? We will write this business, this particular business had taken a loan, or this particular business has a liability of 100 crore rupees, not the owner's name there. Hope the concept is clear. When we move forward, we will have so many terms to discuss, like drawings, where we will find this concept more clear for you. At least for someone, this will be vague concept right now. The second concept, the second accounting assumption is Money measurement concept. From the name itself, it is very clear that money measurement concept says that every transaction that we record in a books of account, that we record in accounting, should be measurable in terms of money. We can't measure how much value we should give for our feelings. We can't measure how much value we should give for our compassion. We can't we can't measure everything, every feelings, every emotions, something like that. We can't measure in terms of money. Okay, such things cannot be recorded in accounting. What that means, everything else that can be measured in terms of money, in terms of money, can be surely recorded as a transaction in accounting procedure. I know you will find it somewhat difficult to understand right now, but when we go forward, you can, with our proper example, we can see it in detail. But now just simply understand that this concept, the money measurement concept, says that every transactions that are recorded in a business, that are recorded in an accounting procedure, should be measurable in terms of money. Now we have the third and fourth accounting assumption. The third accounting assumption says that every business in the view of an accountant or in the view of accounting has a perpetual life. A perpetual means unending life. So it is called the going concern concept. So going concern concepts give an idea that every business have to be considered to have a long life. A accountant should never think a business is going to end sooner. Okay, this concept also have very important relevance in the business. That also we will understand while moving forward. Now we can look at the fourth one. What is accounting period concept? Accounting period concept says that every business has to find its result at least once in 365 days. Okay, every business has to find its result at least once in 365 days. What does it help to? When every business do this, we can make it easy for other business to know, other interested parties to know what happened to this business regularly within a common period. So it makes easy to comparison. Think every business is making their final accounts. See, they are making their accounting reports in 365 days, and think one business is making it once in 722 days. Can we compare these two businesses? No. We can compare all the other business within 1 year, but to compare this specific business, we have to wait for more than 1 year. To avoid this, the accounting principle, through the principle accounting period, not accounting principle, accounting assumption, accounting period concept. So through the accounting period concept, it is said that every business has to prepare its business reports. Okay, the business have to find its business report within a period of 365 days. So it is regularly done for every business together. So these four are the main concepts of accounting that are included in GAAP. Now we can just look at the accounting conventions or accounting principles. Accounting conventions or accounting principles refer to an accounting procedure followed by accountant all over the world. So all over the world there are some common procedures followed by a business. These common procedures are known as accounting principles. Now let's see what are the major accounting principles. There are 6 accounting principles. I am just passing through these words because currently, to a person who don't know what is the real procedures, it would be difficult for you to understand. So I will just mention what that means. We can go deeper in the coming classes. Don't worry about it. Okay. The very first accounting principle is dual aspect principle. Dual aspect principle says that every transaction that happened in a business will have the least two aspects. They are a debit aspect and a credit aspect. Debit and credit means nothing else than two opposite sides. Okay, don't take any other meaning for debit and credit. In accounting, debit and credit means two opposite sides. That's all. So every transaction we record in accounting will have two aspects, two sides. So remember, when we record a single transactions, according to accounting, two items will be at least affected. How that happens we can see in detail in coming classes, but understand according to accounting principles every business transaction have at least two aspects. Now we have the historical cost principles. Historical cost principle says that every asset have to be recorded in its acquisition cost. Now what is acquisition cost? Acquisition cost simply means that cost that are incurred for purchasing the goods and bringing it to the place of use. Think you have bought a machinery from a place. Okay, let the cost of the machinery be 20,000 rupees. Now you have spent 5,000 rupees to bring it in a vehicle to your business, and to install that machinery you have again spent a 5,000 rupees. So historical cost principle says that when you record the asset in your business, when you record this asset in the business in a proper accounting procedure, you should not mention that the price of this asset is 20,000 rupees. Instead, you should add these three elements: 20,000 plus 5,000 plus 5,000, that is 30,000 as the price of this asset. This is what historical cost principle says. So the cost together, 20,000 plus 5,000 plus 5,000, is known as the acquisition cost of the asset. Now, what is the third accounting principle saying? It is saying the verifiability and objectivity principle. According to this principle, every transaction recorded in a business should be verifiable. Verifiable means it should have some source documents. Think you have written that we have made a purchase of 10,000 rupees. Without simply writing this, you should also keep the bill you got from there. It makes that recorded transaction verifiable. Hope the concept is clear for you. Similarly, every business transaction should be able to be verified with some source of this transaction. Okay, these are first three accounting principles. We have three more accounting principles. They are matching principle, convention of disclosure, revenue recognition principle. What is matching principle? Matching principle is that every expense and every revenue that happened in a financial year, okay, should be recorded within the same financial year itself. Hope the concept is clear for you. Every expenses and every income that happened in a business within one financial year should be recorded in the books the same year itself. We can't say it in a single sentence. We need a proper definition for it. I know it very well, but simply understand the concept. I will explain in the coming classes, don't worry. Now we have the fourth accounting principle, which says convention of disclosure. Nothing much important. It simply states that every material fact related to the business should be disclosed through the accounts of the business, disclosed through the proper accounting reports. And now we have the revenue recognition principle. Revenue recognition principle states that a revenue, okay, whatever it may be, a revenue should be recognized at the time when the exchange of goods happen. Just imagine that a person came to your store and brought some books without paying money. He promised that he will pay the money the coming Monday. Now this is just Saturday. He brought the books from us and promised us to pay the money on coming Monday. So the question is, when should we write these sales? Now we have made a sale, right? When should we mention the sales in our book? There are two options. We can mention it on Saturday when the exchange happened. We can mention it on Monday when he make the payment. According to this principle, according to the revenue recognition principle, it is not Monday when we should make the record the transaction. We should record the transaction on Saturday when the exchange had happened. Okay, now we have gone through the 6 principles and 4 assumptions. I know I have gone very fastly. We can't finish it if we are going to explain it deeply, because each and every word needs an explanation for you. Just stay calm. We can study deeply with real life examples. Then you can understand easily when it comes. Now we have some terms. I hope everybody know what all these terms means. What is liability? Liability means, we have told before, money or money's worth that we have to pay to someone. The business have to pay to someone. Okay, the business owe to someone, like our creditors, like our bank loans, or something related of the related nature. Okay, they are called liability of the business. And we have income. What do we mean by income? Income means anything that the business receives, any amount that the business receives through its performance. Okay, so the business perform a certain kind of activity. Let it be sales, let it be providing service, let it be standing in between two business, whatever it may be. The income refers to the money earned through the main purpose of the business. Now, what are expenses? Expense simply means the money spent to earn income. Every business have to spend a lot of money to earn income. All those money spent together is called the expense of the business. Now we have asset. Asset in accounting means, please take a note, asset in accounting means money or money's worth. Anything that can be valued in terms of money. It can be actual money, or anything that can be termed in terms of, that can be valued in terms of money, which can be converted into money when we have some requirement. When we see some money, we can sell some property and make money, then it is called our assets of the business. Now, what is capital? Capital is the investment that a owner makes in his business. Capital is the investment an owner makes in his or her own business. Okay, it is like the owner lending some money to the business. For this reason, we in accounting we consider capital as a liability. Just have that in mind. We will look at deeply when we go to the final accounts. Don't worry. So these 5 terms are of very importance when we are learning accounting. So if you have any doubt, please let me know. I will clarify it through a separate video. To finish this video, I am giving an introduction to what we have to learn further. We are going to do the very first step in accounting, that is recording of transaction. Recording of transaction is done through journals. Okay, journal is the books in accounting which are used to record transaction whenever it happen. Every business will keep a book there for recording transaction that whenever that happens. Okay, nowadays we have computers, we will enter in the computer, but the very first place the transactions are recorded is known as the journal of the business. Okay, now we have a rule on how to record transactions in a journal. I am not going to explain it now, just simply know it is known as LICIC. That means if liability, income or capital, these 3 things we have discussed before, if liability, income or capital increase in a business, we have to give credit. If asset or expense increase in a business, we have to give debit. Now what does this means? I have told you, I am not going to explain it now. Without proper examples, without actually experiencing this, we can't learn this. We can't learn this as a theory. But I want to let you know, we are going to know this in deep. So don't worry, everything we have seen in this video will be partly and in deeply discussed later. I know accounting is another language. Please understand, accounting is the global language of business. So learning a new language is a tough work. But if we practice it equally, eventually, if we make a common understanding on every basic concept, we can do it easily. But commitment needs. Okay, now I am closing this video. Please don't get worried. Calmly have a look at the concept we discussed. We can discuss more deeply with live examples. Then, thank you all.